I want to discuss a topic very near and dear to my heart. It's what sparked my love and curiosity for investing, personal finance, and growing wealth. It's what made Warren Buffett a billionaire. It's what made me a thousandaire. It's magical. It's compound interest. In this video, I'll be going over what compound interest actually is, the best ways to earn compound interest, and the rule of 72. If you're new to the channel, welcome. My name is Nick. If you haven't already, go hit that subscribe button. Go hit the like for the YouTube algorithm. Really helps out the channel and I would very much appreciate it. All right, so there are two main types of interest: simple interest and compound interest. Simple interest is interest earned on an initial investment or a principal, and therefore continually yields the exact same interest year after year. Now, compound interest is interest earned on the initial principal and on top of the interest already accumulated. It's interest on interest. Now that may be somewhat confusing, so I think the best way to explain this is by going through an example. Let's start with simple interest. On an initial $10,000 investment with an annual interest rate of 10%, the total interest after 1 year would be, well, 10% of 10,000, so $1,000 interest earned. This would leave you with $11,000 total. Your $10,000 initial principal plus the $1,000 earned through interest. Now at the end of the second year, you would then again earn 10% interest on the initial $10,000 principal, which would then again be $1,000 interest earned. Now you would have $12,000 total. The same thing at the end of the third, fourth, fifth, 20th, 100th year. You are earning 10% solely on that initial $10,000 principal, leaving $1,000 interest earned every single year. At the end of a 20-year time frame, you would have $20,000 earned through interest. With the initial $10,000 principal, you would have a total of $30,000. Now you may be thinking, well, that's pretty sweet, $20,000 for essentially doing nothing. Now let's look at the magic of compounding interest. This may blow your mind if you've never seen compounding interest before. So just like we saw in the simple interest scenario, at the end of the first year, an initial $10,000 principal with a 10% interest rate would yield $1,000 in interest, totaling to the same as we saw in simple principal, $11,000 at the end of year one. Now this is where we come to the difference. Unlike simple interest, which continually earned interest on the original investment of $10,000, in compounding interest, we are earning interest on the aggregated sum of the principal plus the interest. So in our case, $11,000. The 10% interest is being applied to a larger sum of money. 10% of $11,000 is $1,100, leaving us with an accumulated total of $12,100 after 2 years. Remember, in the simple interest, we only had $12,000 at this point. At the end of the third year, we are now receiving 10% on $12,100. This would now yield $1,210 in interest. At the end of the fourth year, $1,331 in interest. Year 5, $1,464 in interest, and so on. The interest accumulated within the compounding interest is gaining speed. It's the 10% being applied to a larger and larger sum, therefore yielding a larger and larger sum of interest. Bringing you back to math class, compounding interest works through an exponential growth function, whereas simple interest works linearly. By the end of the 20th year, that initial $10,000 investment, instead of being worth only $30,000, would actually yield $67,275. This is why compounding interest can be referred to as the time value of money. The money works harder the longer it is chugging along within whatever investment vehicle you may choose, continually and increasingly reaping the rewards of compounding interest. If we want to really highlight its magic, that initial $10,000 after 30 years would now be worth more than $174,000. Whereas the simple interest would have only yielded $40,000. After 40 years, that $10,000 would now be worth almost $500,000, $452,000, instead of just $50,000. Every year at these big sums of money grows even larger in an exponential function. This is why you may have heard that you need money to make money, the rich get richer. It's not really true, but I mean, like, it is actually. A neat rule to use to see how long it'll take for you to double your money with any starting initial investment is called the rule of 72. Let me explain. All you have to do to use this rule is to divide your interest rate by 72, yielding the number of years it will take for you to double that initial investment. The average return on the stock market is roughly around 8%. So taking 72 and dividing it by 8 yields 9. 9 is the amount of years that it will take to double your money at an 8% interest rate. Let's say we have an interest rate of 4. 72 divided by 4 is 18. I'm going 18. It might not be. So it would take 18 years to double your money. An interest rate of 1% would take 72 years, 0.5 would take 144, and 0.05 would take 1,440. You can see that even a relatively modest increase in the interest rate can yield huge differences in the amount of time required to double your investment. This rule highlights the incredible importance of two factors, that being time and interest rate. It is so important to begin investing at a young age to reap the rewards of time, and it is equally as important to use an appropriate investment vehicle that is going to generate a reasonable interest rate, therefore decreasing the number of years it is going to take to double your investment. If you start investing later in life, it's going to be much more difficult for you to reap the rewards properly of compounding interest. Use time to your advantage. So now we know what compounding interest is, but how do you actually earn it? What are the best ways? Are there multiple ways? The answer is yes. There are vast many ways to earn compounding interest, and in this video I'll be going over 4. So you can accumulate compounding interest very easily through your checkings account. Now, many checkings accounts have extremely dismal interest rates. Some are as low as 0.05%, which doesn't even come close to keeping up with inflation, so your money is essentially losing value over time. As we saw earlier, using the rule of 72, this would actually take more than 1,000 years, almost 1,500 years to double. So it's just really not worth it. It's just sitting stagnant, it's losing value, just sitting doing nothing for you. An initial investment of $10,000 would only be worth $10,100 after 20 years of accumulating compound interest at 0.05% annually. There are a vast number of better investment vehicles for you to use and harness the powers of compounding interest rather than using a checkings account. The second option I want to talk about is low risk investment vehicles such as bonds, the money market, GICs, high interest savings accounts, something where you are essentially guaranteed a return after a fixed amount of time at a fixed interest rate. Now, these low risk options can at the very least keep up with inflation rates for the most part, yielding a return of about 1% to 3% annually. Your money is generating more income than what you would be receiving in a checkings account, and it is virtually guaranteed. Now, I'm not saying just to empty your checkings account and put it into one of these other options. It is good to have money in your checkings account. But what I am saying is that your money is able to do more work for you with you virtually doing no extra work. An initial $10,000 investment working at a 3% interest rate compounded annually for 20 years would yield over $18,000. Third investment vehicle I want to talk about is using stocks. Now, stocks can vary wildly depending on risk profiles. However, there are high-risk options and low-risk options. A very low-risk, stable option that many investors are using these days are ETFs, or exchange-traded funds, with full market diversification and great track records. I have videos explaining some of my favorite ETFs. I'll put the links into the description if you want to check those out. Now, these puppies can yield from 8% to 10% interest rates. After 20 years, this $10,000 investment could be worth approximately $46,609. Now we're really starting to make some money. The fourth way to expose yourself to compounding interest is through dividends. Now, dividends are a portion of a company's earnings that they pay back out to their pre-existing shareholders to keep them around and to recruit new shareholders to invest in their company. Now, when you are paid a dividend on whether it be a monthly, quarterly, or annually basis, you can do whatever you like with that dividend. You can go out and buy a new laptop, you can buy a new smartphone. However, to really expose yourself and reap the rewards of compounding interest, you are best off taking that dividend and putting it back into the market. Therefore, your interest rates are working on a larger and larger sum of money every time you are paid a dividend. DRIP, or dividend reinvestment plans, are a great utility for investors to use to ensure that they are going to be receiving compounding interest. Now, DRIP programs are where the dividend, instead of being paid out to the shareholder, is automatically converted to additional shares at no additional transaction fee to the shareholder. Therefore, the amount of shares that shareholder owns is increasing over time. Therefore, the interest rate is being applied to a larger and larger sum of money, therefore yielding compounding interest. There are many other ways to earn compounding interest, whether that be through starting a business, investing in real estate, crowdfunding, but the key here really is that you want time on your side. To use an incredibly annoying saying, it's not about timing the market, it's about time in the market. Jokes aside, that actually does hold substantial value. You really want time on your side, and this is why it's so incredibly important to start investing at a young age if you want to harness the powers of compounding interest. I hope you learned something. I hope you realize the importance of compounding interest. If you haven't already, please go hit that subscribe button. I'd really appreciate it. I'm doing a lot of videos like this, stock analysis series, personal finance videos. You don't want to miss any of that. So go hit the subscribe, hit the like button for that YouTube algorithm. It really does help out the channel. Anyways, guys, that's it for me, and I will see you guys next time. Cheers.